Let's talk about Meta, folks. I've covered this company a bunch on my channel, and if you know my stance, it's pretty much a buy right now. But take a look at this, guys. Right now, it's currently $200. Now, take a look at this 52-week range here, folks. $88 on the low end, $236 on the high end. At one point in time, at the tail end of, or the beginning of January in 2022, just last year, it was at $300. Then it shot down due to missed earnings to 200 range, all the way down to, as I said, to $88 a share. Now we're coming up. Now the stock price has been increasing like crazy, with a massive jump at the end of January 2023 from $153 up to $186, and now we're slowly climbing up into that $200 range again. Now, folks, I've been saying that this stock price has been a buy sub 200. We're pretty much just there right now. They're making a lot of labor cuts. I think they just laid off another 1.5k people, 1,500 people essentially. They lost their jobs, but prior to that, I believe they let go of 10,000 employees. They're clearing out the excess workers, as well as economic conditions become slightly worse due to this whole banking fiasco, interest rates rising, all that fun stuff that we all know and love. They're making changes to hopefully address their balance sheets. Now, what we were going to try to figure out today, folks, is what we should be paying for Meta today based off of all this data. I really enjoy this company. I think it's a phenomenal business. They own Instagram, they own WhatsApp, they own all these phenomenal social media apps, and now they're looking to compete with Twitter, their main competitor there in the United States. So, ranking this company a 9 out of 10. It's a pretty solid business. They're only getting docked in their price to earnings ratio, sitting at an average of 22.71. Honestly, folks, the software will give you a point if your price to earnings ratio is 22.5 and lower. 22.71 is pretty much there. Even the trailing 12 months is currently 22.67, and for a tech company, that is insane to see something like this, a company this strong, that low, especially in a tech field. Honestly, to me, this is a perfect 10 company, which is very rare to see. I mean, I can ignore this price earnings ratio being knocked off because it's right there. The current ratio is high, sitting at 2.20, so they're extremely liquid in case economic conditions worsen. Their return on equity average is 23.46, which is astronomically high. We want to see that number above 15% ideally, and we're way above that. EPS growth is up over the last 5 years, which is phenomenal to see. Their debt to equity is below 50%, so they are more so leveraged in equity within the business and not taking on debt. Thank God, because as a recession pretty much looms over us, we want to find companies that are not carrying as much debt on them, because that is where things get tricky. And currently, Meta isn't doing that. They've been buying back shares by about 5% over the last 5 years, which is great. Net income is up, free cash flow is up, return on invested capital sitting at a whopping 23%, which is something we would love to see, as well as their 5-year revenue growth is up by 24%. So, what the financial evaluations goes through and what I've been looking at is how strong on their balance sheets is this company? How likely are they to be able to weather a storm? And as I'm saying, economic conditions are uncertain. We've been seeing high interest rates. Is Meta a company that can weather this storm? And the short answer to that is yes, they can, based off of what they've shown here. They're not highly leveraged in debt. Their revenue's been going up. Overall, it is a strong company. Low debt to equity ratio, high current ratio. This is a company we want to have in our portfolio. And frankly, I do have this business in my portfolio. My average cost right now, I think I got it down to $160. So I've been buying pretty much at this $200 range back essentially when it was, but pretty much back last April. So around 210 range. I think I've just been buying on the way down, dollar cost averaging. I really missed the boat. I'm going to be honest with you guys. I missed the boat buying here in November. God knows why. I don't know why I didn't pull the trigger and buy more here, but that was the opportunity. So or maybe I did, I'm not sure. But anyways, my average cost at the time being is $160. So currently I'm up. I'm happy about that. However, I would like it to go further down, if that makes sense to some of you watching this video. Like, why would you want your investments to go down? Because I think it's ultimately a strong business, and my time horizon, folks, is extremely long. I want to look out into the future, like 10 to 15 years down the line. So if I can accumulate shares at an extremely low price, I'll be laughing. What should we be paying for this company? What I'm going to do, folks, is go into the price analysis section here of the software. And if you want to get your hands on the software, folks, 7-day free trial. Follow the links in the description box below. That's www.stockspect.com. This is a phenomenal stock research tool that I love to use to screen through these companies to get the ins and outs quickly and efficiently. And I'm only just scratching the surface, along with all the stuff that I've been showing you here. We have the latest news, along with their balance sheets, income statements, and cash flow statements going back for the last 10 years, as well as charts to see things visually. This is a phenomenal tool, and there's more things going to be added along the way, so I'm very excited for that. I'm going to do a 10-year evaluation, so I'm going to click 10 from the box. You can't see the box, but there's a box drop-down menu. So what I'm going to do, folks, is I'm going to do 3 different assumptions based off of the historic numbers that Meta has shown over the last 10 years to try to roughly predict what I think the company will do in the next 10 years from a conservative basis, because I am a very conservative investor. And what we'll do, I'll put these numbers in and we'll talk about it in just a quick second. If you're enjoying the video, folks, hit that like button and subscribe button. It means a lot to me, it means a lot to the channel. And once more, follow the links in the description box below to find the StockSpec software. If you sign up for the website, you get an invite to the Discord group where you're able to connect with me directly, along with other like-minded investors, where we can all talk stocks, talk everything, and just build a community where we can find great companies together. Anyways, folks, back to the analysis. If you're new to the channel, what I've done here, folks, is I have taken the numbers here from the last 10 years and taken a really conservative approach. I am anticipating, let's say, their revenue doesn't grow as much. This is a decrease in revenue from the last prior year into today's numbers. So if I'm going to anticipate economic conditions to be not so favorable, I'm going to do a really low estimate here of 2% revenue growth over the next 10 years, along with 5% revenue growth over the next 10 years for my moderate, 7% for the aggressive. Now, let's see how that turns out. I kept the profit margin, free cash flow margin, very similar to what they've shown here, along with a very conservative price to free cash flow and PE ratio. And take a look at this, guys. In regards to those numbers, if you believe my aggressive numbers here, which is a very low revenue growth number in itself, with a haircut on the profit margin and a haircut on the free cash flow margin, it's a buy all day. Currently, the average calculation comes out to be 185 on average. So realistically, this is probably way too conservative on the conservative side. The moderate is pretty much, I think, the Goldilocks price, where 184 does seem to make a lot more sense. That is with reduced revenue growth. That is with a haircut on profit margin very similar to the 1 year that they've shown, right? It's actually, it's a discount because it's 19.90. This is 19.5. Free cash flow margin, which is 18, sitting between that 1 year and 5 year number. Price to free cash flow sitting well below what they currently been showing. PE ratio well below, very conservative, and desired return of 13%. 184 seems to be the price. Currently, I'm personally at 160, and honestly, which kind of checks out due to the fact that that number exists right in the middle over here. So if that happens, and if it goes even lower, I'm going to definitely pick up some more shares. I'm still kicking myself for missing out on the boat where it was $88 a share, because well below those conservative average and moderate average. However, what do I think? I still think Meta is a decent buy if you truly believe in these numbers here. However, does that mean go out and buy the stock? No, this is the start of a deeper due diligence. I'm just giving you the numbers of what I believe of how strong the company is. Can it withstand the storm? Is it going to be around in 10 years? And is it undervalued based off those numerics? To those answers, to that question, yes. I can't speak on behalf of you. I can only speak on behalf of myself. So ultimately, use this video as a potential starting point to go deeper into your analysis process. Luckily, If you have this software, you can get the full thing and understand what's actually going on. You let me know in the comments down below. If you enjoyed this video, hit that like button and subscribe button. I will see you in the next video. Meta, currently a banger. If this company goes lower, I'm picking up more shares. Until next time, guys. If you enjoyed this video, make sure you don't miss out on this stock right here. Now, I believe this might be the potentially best investment going forward in 2023, given everything that's happening.